So, welcome to our new episode of Digital Health Inside Out. Just to remind you, the goal of the show is to choose a specific topic, obviously related to digital health, and find the best experts to talk about it, and hopefully to uncover it from different angles and perspectives. So, our first episode was related to um, medical AI and how Gen AI in general influenced um, the health space. To be fair, it felt like we recorded like a year ago because so much happened since our previous episode. It was still recorded in the pre DeepSeek era. OpenAI also released a new model since then, so I feel like we do need to do a second part of that episode at some point soon. Um, but today we're actually going to talk less about technology and more about money. So the topic of our today's show is: Did VC bros destroy digital health? And I'm super delightful to introduce to you to our today's guests. Traditionally, we have with us Sergey Polevikov. We also have James Wen and one and only Matthew Holt. Hello, gentlemen. Yeah, let's
Hi.
start with our short intros. I guess I'll go first. I'm Alex Koshikov. I'm a co-founder of Beaky, a consulting firm focused on building software, hardware, and AI solutions for healthcare. Sergey, you want to go next?
Yes, hi, my name is Sergey Polevikov. I am the co-founder of Well AI, a digital health company, and my background is in math and data science. I also want to say that in my personal journey, I'm on a road to redemption, and that's part of the reason I got involved in healthcare several years ago. And I just want to encourage everybody, to involve more people into digital health, AI, healthcare. There are a lot of problems to be solved. And I think there are a lot of people like me who have done mistakes in the past, but, want to make it right and not necessarily for the financial incentives. Thank you.
Thank you, James.
Sure. James Wang, general partner at Creative Ventures. Since 2016, we've been a early stage deep tech investor. So we've done a lot in AI robotics, synthetic biology, advanced materials. But we've had a lot of companies within the health space. And specifically, though, it's like, for example, portable ultrasound, MEMS-based technologies, cell avatars in terms of for more specific cancer treatments and things like that. Less so digital health, admittedly, but hopefully I can give some context on some of the VC side of things too. Previously, core investment team at Bridgewater Associates, did a stint at Google X, and at least my academic background is statistical learning, which then became machine learning, which then became AI. It's just the evolution over the years. So.
Very cool.
And
Thank you.
I want to add that James has a book coming up on artificial intelligence.
That's right. Sergey, I think, is doing a better job at self-promotion than I am. Yes, I have a book coming out, What You Need to Know About AI, planned for August of 2025. So please look out for it.
Awesome. Yeah, that's great. Looking forward to it. And Matthew.
Fantastic. Well, I love the idea that we have, the non-self-promoting book author. But you're a VC, James, so people need to find you anyway because you have the money. And Sergey is doing a great job of promoting yourself and himself, and you, Alex, too. Anyway, so Matthew Holt, old guy in health tech. I don't have any academic background of any value. I'm kind of kidding. I have a political science degree and a degree in health services research. So I don't understand AI, math, physics, all that stuff is very, very confusing to me. For many, many years, 20 years, 25 years, I've been writing a blog called the Healthcare Blog, which has looked predominantly at two areas. One is health policy, health business, how the healthcare system, predominantly in America, but occasionally elsewhere, is developing. And the other one is sort of what's now called digital health, which used to be called Health 2.0 when I started phrasing. Actually, it was called eHealth before that. And I ran a conference for many years called Health 2.0, which featured a lot of that. So I've been kind of stuck in this weird position between being very cynical about the healthcare system and the practices. I mean, it's kind of amusing to me that Sergey says he came to healthcare as some kind of redemption. Most people in healthcare need some redemption. Very simple about how the healthcare system operates. But on the other hand, hopeful that some of these new technology companies that we've seen coming into it would do something to change it. I'm getting more and more cynical about that part as well. But I guess that'll be the focus of our discussion here. But and now I spend most of my time when I'm not sort of connected to my blog, the media site, and talking, doing this kind of stuff, helping early stage companies try to figure out how to meet VCs and raise money and get from sort of 0 to 1 to 2. And it's not easy.
All right. Thank you very much. So actually, I want to start with giving you some data, and I think lots of people in digital health kind of already know this, but still to remind you, the total venture funding in digital health, let's start with 2020, was $14.3 billion. In 2021, it boomed and peaked to $29.2 billion, declined to 15.7 in 2022, 10.8 2023, and we're almost got to that number in 2024, but it's still a little smaller. It's $10.1 billion. But I do hear a lot of optimism regarding 2025. We hopefully going to beat last year number, and also there's definitely going to be more M&As happening, and we actually already see that in 2025. Some of the mergers and acquisition happened in digital health space. So James, let's start with you. Can you tell us what do you think how the pandemic actually influenced the digital health investment space, and what should we expect in the near future?
Yeah, totally. I mean, that chart that you just talked about, just in terms of the visual of the ramp and then crash, actually parallels most startups. So in terms of like startup financing and VC financing, in terms of how much VC has got money, there's a pretty big parallel where you have 2021 being kind of the big hype period, and then 2022 essentially having that crash down, especially as interest rates and everything were going up. So that part is similar. However, for digital health, I'd say it's bigger because, especially during early COVID, everyone was worried what's going to happen. But by 2021, the idea was, look, all these RPM codes, all this interesting stuff, that must mean that digital health is going to go through a boom. The entire healthcare system is changing, so we should pour money into it. 2022, with money, a lot of money being pulled back and a lot of different digital health companies not really doing as well, basically pulled that back a lot. And especially as the RPM codes were started rolling off and other stuff that from the FDA that also became just harder in terms of environment. So we've kind of been in a winter ever since for the area, and public like digital health and just healthcare stuff in general has been doing poorly. 2025 is hard to say, honestly, because the issue is interest rates probably aren't going to come down. This is my old macro hedge fund sort of hat talking about it. So it's probably still kind of a wait and see. One of the big catalysts for the private markets will still be like, are we going to see more exits? We are seeing more exits. Maybe the new administration, that's the argument. It's like maybe because of that, there will be less anti-competition, like things in terms of the FTC and stuff. So maybe there's more acquisitions and stuff too. But I'd say we still have to more wait and see. It's probably going to be better than last year, but in terms of if there's going to be a boom again, still to be determined.
Yeah, it looks like with the new administration, most of the topics we usually talk to, everything ends up with we do not know what to expect. Uh,
Craziness.
yeah,
We're seeing that already, and we'll expect some more of that for a while, I think.
Yeah.
true. So, Sergey, a very simple question to you. Did VC Bros destroy digital health?
I think the problem is, and I've talked about it a lot, is that we have concentration of capital in a very few hands in digital health. And unfortunately, that concentration has not done well. Especially I'm looking at maybe last 10, 15 years. There are certain players that are dictating where money goes. In my view, it's a very close circle of people, who gets the money, who doesn't get the money. Unfortunately, people who control the money have no clue how to pick winners. And as a result, if you look at numbers very carefully, you see that the VC-backed firms, they've been losing money left and right, and real innovators have been kind of on the sidelines. So that's been a problem. One of my latest research that I've done, I looked at publicly traded companies. I identify 132 companies. If you really go into the sourcing and who invested the money into those companies, and essentially have two different stories. If you look at VC-backed digital health startups, they lost about 70 billion in earnings over the last 5 years, and bootstrap companies actually gained not a lot. So we're talking probably broken even, but that kind of shows that even though we see those people at conferences and they all wear V-necks and whatever turtlenecks and seem to be smart, but unfortunately numbers show the opposite. But I think the biggest problem is this brotherhood, that in my opinion, it's a lot about who you know in this industry. And if you don't know the right people, even if you have the best ideas, you may not be able to implement those ideas. And their arguments, it's never been the case. You're looking for outliers always, and who cares about the median? But if you're talking from an asset allocation standpoint, you're looking at venture capital and probably private equity as this illiquid asset class, and sort of by theory, but what we've learned in the MBA programs, whatever, you expect certain things happening. And so in venture capital in general, I've seen numbers like 2015, 2016 vintage. We're talking like barely making 1x. So you just return your money, maybe even less, at a time where public markets went up, 2-3 fold, 300%. So yeah, I think we could talk about stories and particular examples and people picking winners and Teslas and Airbnbs, but I'm talking about general story. And last 10, 15 years have not been great for venture capital and digital health in particular, in my opinion.
All right, thank you. Matthew, what's your take?
So I think you've got to think about the underlying issue that's going on in the healthcare system. So, when I was a young boy, my good mentor Ian Morrison, who died sadly this week, and I talked about this, and we were thinking about you could get to a point where you would have a what was then called managed care system, in which and to some extent you're seeing some of this in Medicare Advantage and some of this in the commercial sector, but the goal was to have something like a bunch of competing Kaiser Permanentes. And the goal will be that you would then allocate a certain amount of money from the end payers, by the employers, the government, consumers, whatever. And then these at-risk medical groups essentially would control that money and will figure out what is the best way to spend money on the population that they're managing. And that would inspire them to do all kinds of good things, which would, you talk about remote patient monitoring and, chronic care management, all this, the buzzwords we've heard about, to do that at scale and to reduce costs by basically keeping people healthier and making them better. And a significant amount of the dollars going into digital health, even going back into the 90s, but certainly going into sort of the late 2000s when it was just starting to pick up, and certainly in the teens and the last few years, have been gone to companies who are trying to do something in that era, in that arena of making people healthier, better, managing the progress of patients outside the hospital, managing the process of patients, keeping them well, chronic care management, all of that stuff. If you look at all the people who are getting money, a significant number of them are doing that. I would say that the underlying problem has been that the healthcare system has never gone to that kind of a payment system where, we have Medicare Advantage, we have some commercial plans who are doing some value-based care, but in general, we stayed the same old fee-for-service system we always have been. And if you actually look at how, and I've written on this quite extensively, how big Medicare Advantage organizations pay their medical groups, Humana publishes on this every few years, they actually basically pay them fee-for-service. there's a small number of them for whom they give them the capitated risk. So you're not putting, and maybe the health plans have got systems in place to try to manage care. And obviously, there's a lot of controversy about United and their use of AI to do that right now. And are they going to be sued? And are they going to be prosecuted? But as you get down to it, you're not really getting to the market I thought we were going to get to 30 years ago, which is be a bunch of capitated medical groups that kind of look like law firms across the country who use all this technology, or are technology companies themselves to manage the care of patients. People keep on trying to do this, right? You're seeing every day someone will get funded with a new online care system, which is trying to manage migraine or trying to manage uh, women at the age of menopause or whatever. But it's not. Most people now still get their care from either undifferentiated, private doctors out there or big health systems. And the big health systems don't give a rat's ass about saving money or care management. They make all their money and always have done by doing a lot of procedures in the big surgery suites in cardiology and neurology, neurosurgery and orthopedics and general surgery, right? So you don't have a system that's set up for these companies to succeed. So I think that's the underlying problem. Then you have to look at what happened. You had a lot of money in that sort of the period. Really, it was 2021 was the height, but it was really sort of when we started flooding the zone with cash in mid 2020, right after the pandemic, through to about 2022. But if you looked at the numbers, as soon as you got to the end of 2021, the public companies started collapsing in value, and it took the private market about 9 months to a year to figure out, hang on, the thing that I'm investing my hundreds of millions from SoftBank or from Katui or from Tiger, the thing I'm investing my hundreds of millions into that I've just valued at 3 billion has a public market equivalent that is now spacked out and is only worth, at that point 1.5 billion, now worth 500, 300, 200 million or nothing. And it took the private market VCs a while to figure out that, especially the sort of tourists with the later stage funds, it took them a while to figure out that this was that they were investing in stuff that wasn't going to be worth what they thought it was going to be worth when Teladoc was at $300 a share and worth 40 billion and had bought Livongo for 19 billion. It didn't look like an idiotic deal. So if you rip all of that stuff out, there are some winners, but they're not winners in general. And I'll say the one exception in a second. There are some winners, but they're not in general helping move the market towards sort of population health management and consumer health, managing their own healthcare and chronic illness and all the stuff that costs money. They're winners in small areas, like there's a bunch in revenue cycle management, which is just, can we keep more money for one player and take it from the other? Increasing now in selling consumer stuff that health plans won't pay for to rich people, particularly GLP-1s, which is why the HIMSS stock price seems to be, 42 or 45 or whatever, rather than the sort of probably, 8 to 10 it probably should be at, even though it is apparently unprofitable now. And then the old standby of we can market drugs to doctors, and Doximity, which is the standout hit, which has done a fantastic job putting together a community of doctors, giving them a bunch of services and monetizing that by selling, drug company marketing, which is just taking some of the drug company marketing budget, which has always been huge, or always double what the R&D budget was, and tilting a little bit towards them, the same way that Google took a bit of the newspaper advertising budget and tilted it all towards them. So my sense is that overall, you can blame the sort of tourists for not really figuring out how they were investing, but they were always investing into a market which didn't really want them. And that brief moment of time when we thought things were going to change during the pandemic, they never changed. And the real reason, and I'll shut up after this, I'll shut off after this with my one coder. The real reason that it didn't change is just to look at, how the big health systems who run this healthcare in this country, the big non-profit systems and, HCA and Kaiser and others, reacted when the pandemic happened, right? They lost all their elective care, all those neurosurgery suites and orthopedic suites had to stop, and they started bleeding money. And they had a ton of money in their reserves. Did they touch that? No. They went to the government, put their hand out, and got money from the government, the CARES Act, right? Gave a ton of money to those big systems. And you would have thought at that point they would have gone, hang on, it's not very rational for us to be involved in a system where we're getting paid fee for transaction, why don't we go to the government and try to switch the system and get paid some kind of global budget to manage all the stuff we have to do? Because now we're doing, COVID, and now we're doing general care management. We're not doing so much of that intensive surgery. And the Australians, they didn't do that. As soon as they could, they got the COVID people out of the hospital and they started filling up the emergency rooms and started filling up those operating rooms and went back to the way they did it. And by the way, when the Change Healthcare hack happened, and a bunch of people started going to business again because they couldn't bill fee for service. So my sense is that there's very little interest in changing the system. The one coda I would have is that there's one, if you look at consumer health, where we have, the iPhone and Zoom and Google, well, it's different, sorry, consumer non-health, consumer technology, where we have all these different players, who came out of nowhere, Amazon and Apple and whatever, doing totally different things than was done before. Is that they were doing different things that was done before. They weren't really replacing much. You can argue that, advertising replaced newspapers. You can argue that Netflix and Apple movies have replaced, TV, but it's generally new stuff. And there wasn't much to replace in mental health because we did a very shitty job of it. And we had a massive increase in demand coming into, basically since you mentioned the iPhone, but exacerbated by the pandemic. And you have seen some real establishment of some real mental health, independent, technology-based medical groups. And they seem to be doing, okay. Although the ones that are public, like Talkspace and BetterHelp, part of Teladoc, are not probably doing as well as some of the private ones. It'll be interesting to see what happens when the Lyras and the Headspaces of the world have to actually show their numbers to the world. I'd be interested to see how they're doing. But my impression is they're doing better because there's pretty solid demand for that. So I'll shut up because I said a lot there. But my sense is that it's a very complex picture, and you can blame the VC bros to some extent, but I don't think that they've been investing in a market that wants their investees that much.
Thank you. James, I really would love to hear your thoughts. And especially, I love this Matthew's thesis that the health system isn't really built for digital health startups to succeed. From VC perspective, what do you think about it?
Yeah, I mean, I completely agree with Matthew's point, and I'll just underline it, right? It's a cost. What you're trying to sell hospitals is we want you to do this thing in terms of digital health and similar sort of things usually, not make any more money. I mean, the argument for the startup is always it manages it better, it's better operationally or whatever, but you pay this out of pocket off of your balance sheet. You don't get necessarily any more reimbursements from it, or at least I can't guarantee it for a lot of these different digital health startups. And therefore, what? It's like it's a far easier sell, unfortunately. Like I think it's a tragedy of the healthcare system as we have it set up, especially within the US, but a lot of parts of the world, where essentially the best sell is that you get more money with our thing because it helps you do more procedures and get paid more. The real like startups that get a lot of funding or whatever, therapeutics, because it's a pill, you like, prescribe it, whatever. We don't do therapeutics, but we see it. Or the alternative is you make the argument to the hospital. Every time a patient walks through the door, it's like the cash register, like ringing. Like, like if I can make an argument to you that I can help you bill more procedures with this thing, it's a new procedure, or it's a thing where it's like we can justify doing more of these procedures or diagnostics or what have you. That's an easy sell. It's an extraordinarily hard sell, and I've seen it, like in terms of hospital systems, where it's just a lot of hospitals will pilot things. You have sort of your normal names on every single startup deck where it's like we're being piloted at Kaiser, at this, at that. It's like it's always the same names, and it always like it very rarely turns into anything real within the broader system itself. And the reason is because, again, your sell is essentially within a system that pays you per procedure, per thing in terms of it. This is just a cost. I'm doing just fine in terms of where things are, and you can't guarantee me that you're actually going to raise my ability to make money in terms of this. So the reality is it's just tough in terms of that. And the thing is, I agree with Sergey in terms of just A lot of the different VCs don't really have great subject matter expertise. A lot of them came in sort of chasing these returns, especially as you saw, like, the pandemic stuff and like it got hyped and everything. But at the same time, the failure mode wasn't because they put the money in. The failure mode was because the system just ended up not really adopting these things as much. Or when you give it away, the system might try it. But then by the time you actually try to turn it on in terms of payments, in terms of having the hospital systems actually pay, that's where it failed. So I mean, I'd say that just in terms of nuance, and I really do agree with Matthew in terms of his synthesis of how that works in the system.
Venture capitalists, there is the whole distribution, right? I'm mostly talking about people with concentration of money, right? So we're talking, pick your name, Tiger, General Catalyst, Andreessen Horowitz. So, I mean, those are the guys with the money. They have not delivered for sure. There are a lot of smaller VCs who are doing their due diligence, who are doing their job, who are investing pretty well. So I shouldn't be generalizing. So I just want to make that distinction.
Can we dive into that a bit because you know there are a couple of them. So all the ones you mentioned, right, have made a ton of money outside of healthcare. So now, and obviously, if you add in General Catalyst, which had I know some of the investors in Livongo who turned two into 50, or three into, or 30 into 500, before the stock run up, right? This was just at the IPO. So there was a lot of success from that. We don't know. We know General Catalyst owned a big chunk of Livongo. We don't know at what point they sold, but clearly it was a very good thing for them. They're sitting on a massive investment in Stripe, which I don't know how much of that they liquidated, but obviously they have a lot of firepower, right? And they are now doing all kinds of other things. They just announced that they're doing a fund with Eli Lilly for biologics, and they just announced, or pharma stuff. They've just announced they're doing private equity management for I don't know who for, but I don't think I'm rich enough, or maybe you guys are, to qualify to get their wealth management. But they're clearly heading down a different path, right, than a traditional VC. But most importantly, right, they put together the group that Hemant Taneja calls Health Assurance. They've got a whole bunch of ex-senior healthcare system people in that, experienced people who understand the health system well. They bought a frigging health system, in Ohio, Suma. They're going down the path, and they're going to start using the different vehicles they've got, who include Transcarent on the consumer side, clearly Commure, which is now kind of a holding company for a whole bunch of different hospital sort of operating system stuff that they've got. So they're going down that path in a big way. I don't know if it's early enough to call it a failure, because eventually, we're going to have a technology clash in the hospital space, which is basically Epic versus alternatives to Epic. And Epic's a very strange beast, right? The core EMR with a bunch of now stuff floating around it, working in virtually every major hospital system in America. I don't think you're not going to remove it. There was an attempt by Jonathan Bush and Athena Health about 10 years ago to build an alternative to it. He was going to do an inpatient cloud-based EMR, and then that got killed when the Elliott Capital Management folks came in and forced him out, and they just turned it back to the revenue cycle player it was and made a lot of money themselves. But you've got Epic expanding, and if you read Brendan Keeler's stuff, they're now expanding all these different areas and trying to sort of do more and more with AI. And the question is, are there a group of companies, for General Catalyst on the sort of hospital and hospital/payer side who can build up enough technologies that are required by the current providers that Epic won't kill it all? And that's a very open question. That's clearly the bet that they're making on that side. I would agree with saying that if you were to sort of take out Livongo and take Andreessen, forget Tiger and Katui and SoftBank and the tourists, but take the serious people who've been doing VC and health tech for a long time. I would say Andreessen, General Catalyst, Bob Kocher and Brian Roberts of Venrock, a bunch of others as well. If you added it all up at the moment, it's not positive, right? They're still down. The question is, 5, 10 years down the road, do those sort of investments trying to build a series of technology companies or a technology keiretsu that can go up against Epic, is it going to be successful? That's the question. That's the question you've got to ask about the future of venture capital. And then around and outside the world, there's a bunch of little things, right? So, you can have a successful company like a Hims or a Row or whatever, which is doing something that hasn't got anything to do with the mainstream healthcare system. Yeah, I buy my GLP-1s or I buy my baldness. I don't buy my baldness pills from them, as you can tell, but I should have bought my baldness pills from them, right? And that's just a different consumer good. You've got the Doximity's doing marketing. Look around, there's a ton of people doing different stuff. But in terms of core assets that manage how most people buy their healthcare, I think the jury is out, even though the jury is probably leaning towards, not going to make it.
Hey, Matthew, do you consider Livongo a successful investment?
Look, but by the way, we should talk about the Defined Ventures piece that just came out because I'm in the middle of writing about it and I haven't finished it yet. But they basically say yes, this is a super successful investment. Look, it's an if
you want to take a guess what's the Livongo's asset value right now?
Well, I mean, the whole thing is under 2 billion, so their part might be, if you can break it out, I know
exactly less than half a
900 million or something. But that's not the point. The point is, where did this is stock trading. If you bought at 2 and sold at 300, it was very successful. If you bought at 300 and wrote it down to 2,
that's exactly my point. That's exactly my point.
But we can argue about a bunch of stuff that went spacked out and never, your friends, your favorite Babel and others, right? Who spacked out, got on the public market, people bought it and it went straight down and it never had a rally. But the people who bought in early in venture capital and sold out either at the IPOs or later, for them, it's a good return, if they got it right. Like I said, I talked to a guy at JP Morgan who made 20x on his Livongo investment. It's a good investment for him. It is fun to.
That's exactly right. That was my point. That a lot of this, financing what VCs are doing. Unfortunately, it's pump and dump game. So it's not that the investment was a good investment. It's when do you get out? So if the question is when is the exit and how do I get out on top? To me, that's not a healthy environment for healthcare right now.
Oh no, I would agree, Sergey. That it's that's not. Look, the best venture capital investments are the ones where the VC can take out their money, leave a bit in, and the company steadily grows on forever, right? And that if you go back historically, I'm talking like last century, VCs would wait till the company had like 2 or 3 or 4 or 5 quarters of good earnings, then they would IPO it and they would stay in for a while, and the company would steadily grow up and eventually become Apple or Cisco or whatever, right? And the people who stayed in from the very start did very well. And in the late 90s, and then again in, the late teens and certainly early 20s of this century, it became, can we put a company that is losing a ton of money out on the market and hope that it will rescue itself and, by the way, sell it for, 10, get 10. Well, initially it was 5, now it's 10/20 times revenues. So, I mean, I love to hear from you guys, especially from James, about this, but it seems to me that that's okay with venture capital now, and that's more or less okay with a lot of public market investors who are much more gamblers than they were, seems to me, when I was a kid.
But that's a really important question, actually. And James, I'll give you a word in a sec. But I think my question is, do you feel like right now there's not enough patience on the VC side because they're all thinking not about patience, not about care, but thinking mostly about ROIs, and they are pushing startups to go either public or merge with someone or being acquired just to get their money back. And in many cases, that is the reason why those companies afterwards they fail, because they were pushed and moved to scale so fast. So do you think that is an important case here or not really, James?
I mean, let's make a distinction between two of those points, right? Because there's the exit side of it that we're talking about and pushing to exit, and the scale. Scale is always, right? Like the entire reason why someone would take VC, and I'd say for entrepreneurs and whatnot, thinking about this and looking at it, you need to be able to take that money and immediately translate it into massive growth. That is always like the VC bet, deal, treadmill, what have you. And if you can't do that, you shouldn't take VC money, just frankly speaking, because you're going to get all sorts of things messed up. It's going to be very expensive money as far as it goes, especially if you aren't growing fast. It's cheap if you grow fast. It's very, very expensive to ruinous if you can't grow fast. That's one side of it. So I do agree in terms of scale effects and certain companies probably growing too fast. That's a problem, but that's also a problem in terms of ecosystem, right? Like some of these founders shouldn't be taking VC money at the stages that they do, but it becomes a hot thing and you get a lot of money and things like that. And so I understand, but it's also potentially deleterious to the overall enterprise value or the founder value or everything else over time. The exit side's a little more complicated, right? Because I think like Matthew was talking about Livongo and General Catalyst and stuff. Maybe some people did well in terms of some of these different companies, but the problem with the SPACs is actually most VCs did not do well. Why? Because you have lockups. So if you just literally go from, hey, I looked up a press release and had a can guess like what their price per share was or whatever, what their value was at the beginning, and then I see what their IPO is, you can basically go, oh yeah, they did really well. Except they have 180-day plus lockups usually, and in certain cases of the SPACs, even longer, where the SPACs went up and then they came down in a huge way. And by the time you actually see the lockup ends, it's like it's at sort of the bottom in terms of it. So they also didn't do particularly well for those investments, especially not for VC. So you kind of have to make those distinctions. And ultimately for VC as well, if you think about incentives, the entire power law thing does apply, right? Like if your thing there is that this is a really great company, I'm going to make my entire fund off of this, you don't want it to go public or exit or whatever early before you actually get it out because this is your one shot to basically make your fund back and make it look good. And that typically is for most VC funds the case. It's like one or two, which means if you screw up your one or two shot, your fund is toast. So I would say in terms of like the exit side, the incentives aren't aligned just to like push the companies out or whatnot, unless the company's just not doing well, in which case it's like, okay, well, you should sell or do something or whatever to at least get a little bit of money back. But those also aren't going to be blockbuster IPOs or SPACs or whatever either. Those are probably going to be acqui-hires or similar kinds of things. So I just put that nuance in there in terms of the two sides of it.
No, I believe more creative ways of, exiting even for venture capitalists. But yeah, I mean that's a good point. And the second point is spec operators actually did great. So
Tremath, who's now off, criticizing the government, seems to have done okay out of Clover and Virgin
right,
Galactic and a few others.
or they got like a couple of billion in a couple
I'm
of
not
years.
sure the people who bought those companies when they SPAC'd out did particularly well, especially the poor people who thought that Clover was going to be a meme stock like GameStop and bought it at 25 or whatever it is. Never got back above.
That was wild, wild west. It's unbelievable.
I mean, but it is true. Yeah, I agree. I would say, that if you can argue back and forth, but I mean, there is. I was actually really interested in this Defined Ventures report to see that there is somebody who's created an index of loss-making SaaS companies who are public, and I didn't realize there was such a thing. But they basically said compared to that, the digital health guys aren't doing that badly, which I thought was well, that's like okay, but these are companies who 20, 30 years ago would never have gone public, and I guess that the question is there are a lot of people in talk about James saying people are taking VC money. There are people who take too much VC money, right? That's clearly been the case. And I've actually talked to some of my friends who run companies saying, I don't think you should have taken the next 50 million. I think you should try to grow slower. And they come up and say, there's a combination of reasons why they do it. One of them is everyone else is doing it, and if they don't do it, it looks like they're doing something wrong. So you end up with like 6 or 7 companies all taking 200 million bucks who do nurse staffing because in 2022 and 2021 and 22, nurses couldn't get staff, and that was a very profitable business. And you know that most of them are going to die, or are already dying. But you know, there is a sort of lower level thing of smaller VCs. I mean, it doesn't matter if you're Andreessen or General Catalyst, these returns don't matter to you. But a smaller VCs going into companies that, can get sold for decent amounts of money because they're solving a particular problem. And you are seeing, a little bit of that, right? Where there are some decent returns for companies who raised, 8, 10, 12, 20 million, but didn't go and raise 80, 150, 200, 400, a billion or whatever. So there is some of that. And there are always sort of niche pickups within the world of M&A. The other thing, though, is, of course, you're seeing a lot of M&A, which is forced by its investors because there are 2 or 3 companies being slammed together that have all raised too much money. And the investors are going, okay, we have to cram them together. And, actually, General Catalyst and Kimura is clearly a big one of those going on right now. But I mean, there are many others. Yeah, and I think you talked about Truepill, Sergey, which allegedly was a $500 million deal, but really actually was like a give it away free with because they couldn't figure out how to make the underlying business work. There's a lot of that, So and a lot of those are because the underlying business didn't fit into the health system the way they thought it was going to, or the health system didn't change fast enough so that you needed whatever it was that a Truepill was doing.
Maybe actually pulling one of those pieces out, Matthew. You were talking about some of these companies doing well with just, 5, 8, $10 million in terms of investment. One of the potential bad incentives that has actually gone into the system and going towards Sergey's piece is how big some of these VC firms have gotten. Because if you're talking about that and a 10x return, say, right? And 10x is pretty good, right? I'm oversimplifying the math massively, but just say, yeah, I put 8 million into this at 10x or whatever, it got me 80 million. A lot of money, unless you're a multi-billion-dollar fund, in which case it's nothing, right? So it's like, I'd much rather you have 2x or 3x my 200 million rather than you doing whatever it is with my 8 million or something like that. So there's a little bit of incentive there to try to push more money into some of these companies, especially with some of this. So I'd say there's some bad incentive there potentially, and you can argue like that distorting the ecosystem.
I mean, I'd agree. My impression is that, earlier in the ZERP era, we got way too much money going to venture capital as a whole. And there are some weird distortions. I don't understand the tax reasons, but there's some reasons why university endowments, which have been growing massively, want to put more money there. But it seems to me we're getting a bit of a retrenchment of that, and eventually that'll wash out. And it's been much harder for some funds at least to replenish them. But we are seeing in healthcare, just in recent weeks, we've seen some recent weeks and months, some of these $100 million plus deals, well, they're coming back that were every day between sort of mid 21 and early 23, but now, kind of went away completely. Some of them started to come back, which implies that those later investors either, the money's burning a hole in their pocket when they could stick it in the bank at 5%. Or whatever, or they really believe that the IPO window is coming back and then we're going to see some of these companies get out. And I think the most interesting thing in that perspective is to see what happens. I mean, we had, if you squint hard, Waystar, which is a revenue cycle management company, and Tempus, which is some kind of weird AI, diagnostics, genomics company. I don't quite understand what they do, but they got out and they seem to be doing fine, right, on the market. They've gone up since their IPO is not down. But the sort of core, quote unquote, digital health companies that you've got lined up, particularly Amada, particularly, Hinge, I suspect you've got, others like Maven and presumably, Kaya Health and others in that lineup. Who knows who else is going to be in that lineup? We're going to have to see what A, their numbers look like when the rest ones get published, and B, when they do get out, what happens. Because some of those companies, by the way, have been sitting, Amada was founded in 2010. It's not like, a quick pump and dump for them. It's been 15 years as a private company. I heard that Included Health was now, thinking about going public in 22, actually, hasn't gone public, is apparently profitable now. Would love to see the numbers there and see if you can establish some companies. And also the other thing, just to finish this point, is some more of those public companies that are dead, but kind of dead men walking, but are valued at 200, 300, 400 million, the lower end of Sergey's list 123, they've got to go away, and some of them are, right? Transparent bought Accolade, rolled that up 600 million or something when it was trading at about a value of market cap of 300, but it had been trading at a billion, not very many months earlier. So maybe it was a good deal. Buy them some market share, maybe you see more and more of those roll-ups, including the public companies, which will give some space for new valuations for the Hinges and the Armadas to go public. It's going to be really interesting seeing that.
Just to add color on two of those points, the endowments and pensions thing I can actually speak on because I worked with a lot of them in terms of Bridgewater days and whatnot, and also on the VC side. The reason why was because interest rates were so low. If you're trying to pay pensioners and you promise them a certain percentage, just because interest rates are zero doesn't mean that the pensioners will go, "Oh, I understand you not paying me anymore." Right? So you need to go farther out on the risk curve to go get returns, which is why VC became so popular, and PE and these other things that are higher risk. Interest rates haven't come down back to zero, which means you're not going to see that same kind of surge anymore. On the other side, VC funds have actually gotten longer and longer in the tooth. Like technically, most fund structures are supposed to be 10 plus 1 plus 1. There's two 1 year extension periods. In reality, if you actually talk to investors in VC, they kind of joke about it. It's like it's 10 plus 1 plus 1 plus 1 plus 1. It's like the true length of most VC funds is actually now like 15, 16 plus years. And you can see various reports on this from Carta, SVB, some of these other folks. Um, and the thing is, it's like it's hard to pump and dump because the issue is it's like the time frames are so long in terms of, and you were talking about Livongo, these others, like how long they've actually sat there. And these are just, again, just two nuances in terms of just looking at the ecosystem within VC and what's evolved over time.
Right. I agree with that, and that's why I don't expect many IPOs this year or next year, to be completely honest with you. I mean, we talk about Modern and Hitch, and I guess that's because they announced. By the way, it's been like 8 months, and nothing's happening. But like outside of that, I don't expect many. For that same reason, is that I think VCs are finding more creative ways to become rich. They don't have to go public, to be completely honest with you.
So do you think Hippocratic is not going to go public anytime soon?
No, not anytime soon. So I mean, yeah,
That company is, by the way, quote unquote, officially, only 14 months old, So,
Do you know what their
To your
annual?
previous point, they raised 2 rounds of investment the past 4 months, I believe.
I mean, but I'm saying well, and there's a weird thing going on. So and I love all of your comments on this one, right? So there's two things going on at once, right? One is there has been a kind of a rejigging, and we've talked about Cumulus a couple of times. I've talked about Cumulus, but Hippocratic's there, also another general catalyst company, and a bunch of others. Qdentis raised a bunch of money, Innovasa, others, who are kind of inside the hospital operations plays to go up against, essentially to go up against Epic, and there's a bunch of companies. And you go on the HIMSS floor and you wander around HIMSS, yeah, you see the big Epics and, Cerner is still plugging away. Well, Oracle now plugging away and Meditech are all plugging away. But you see a bunch of other companies on that floor. And most of them are doing weird stuff in the back office of hospitals that you've never heard of, right? But are really big players, and my sense is there's a bunch of people coming for them, like the people who do document management. That's another revenue cycle management stuff. There's a bunch of people coming for them, operating rooms, scheduling, and all that stuff, right? So I think a lot of guys are going for coming after that segment, and which is where those big rounds are coming. So that so to me that's one big chunk of the activity. The other thing is that there's AI woo-woo in general. Obviously, ambient AI in healthcare is the big area. In healthcare, ambient AI with Nuance by Microsoft, but also Abridge, Nabla, Ambient, I can't remember, and a bunch of others, right? Suki, a bunch of others who are venture backed or others, and that is growing super fast. That part of the market seems to be a very product that really helps the doctors flow, and it's not that expensive for the savings they're getting. Yada yada, probably fits in James's. We're actually going to save you money and help you bill faster because you can see more patients equation. And then this is all against the background. And then when you say, so I think only one or two of them are going to get out, where the stock market is insanely high, right? Based mostly on the valuation of 7 particular companies, one of which is the CEO, which is running around trying to destroy the American government and the world at the moment as we speak. So, but it's all based on AI. And as we said, you mentioned at the start of this, Alex, DeepSeek, right? People are still trying to figure out, does that mean that all this AI spending is crazy bad, crazy good? No one quite understands what it means. But if you look at the sort of overall stock market, if you can't get out now with the amount of fervor and the height of the stock market, what's going to happen in 2 years if we have a bear market? If AI goes away, then they're never going to get out. So my sense is that, yes, I know things were crazy in 2020 and 2021, but they're crazy now again for different reasons. Just we have this problem with digital health, the failure of digital health, whereas all the other companies that went public in that time, many of them have done pretty well. If you look at the general SaaS companies and the AI companies, and there are areas, biotech, James, is an area which hasn't done so well. But to me, I think you've got to argue that, yeah, there's a lot of money that's been sitting there patiently for a long time. Now, yes, Sergey, you can say people make money other ways. They make money on their 2%. There are secondary sales. There are, companies that seem to be never going to go public. I mean, why is Stripe not gone public when it's worth, 100 billion? And, it's been around for a long time. Those guys have figured out they don't need to go public, even though they have investors' money in there. But in general, eventually the investors need to get their money out. And the only way you get it out is an M&A deal or in general, is a big M&A deal. Private equity comes in and buys it, or you go public. So we're not seeing enough for those. You guys understand better than I do how the Stripe brothers managed to be the richest guys in Ireland or in Europe without even going public. But
yeah, they said explicitly we're not going IPO. So I don't remember why,
but they have a ton of venture capital in there, and at some point, those guys, as James pointed out, need their returns because they're limited. Have to pay their pensioners. They have to send their pension. I wish someone would give me a pension. Should have worked for the government, although I'd have been getting one of those ladders by now.
Hippocratic is actually a good example, I think, of why venture capital is not going IPO. And let's be honest, those companies, they're run by venture capital. Founders or opinion is basically so minute is not even funny. So right now, with the latest valuation, do you know what the multiple is on Hippocratic revenue? It's exactly 200 right now. Have you seen any company, over 100? I mean, they schlep valuations like they basically wake up and say, what, how are we gonna value? And it's because, again, and James knows that stuff. You have a basically a group of VCs, sitting at a table, drinking beer. It's very different going to public markets and basically being exposed to million votes out there, and they know that's not the valuation. They know it's not 1.6 billion. I mean, it's never going to be. But in private markets, they can do whatever the hell they want, and so there's a little bit of that going on. So why would they go to public markets if they're sitting right there and waiting for some schmuck to come in and say, oh, we're gonna unload a few shares here and there. So yeah, I understand secondaries are completely liquid, but you're just waiting and then seeing what happens, because they know for sure public market is going to destroy them. That's going to.
I'd love to hear James talk about this because they have to get out at some point, right? And yes, you can make up a valuation that you like. Also, what's the valuation of the money you put in versus the next round of money coming in, right? And what's the ability?
That's exactly right. Yeah.
Your preference rate, and do you have a 3 times liquidation preference, all that kind of good stuff, right? So it depends who you are as to what the valuation is. I remember Jeff Tagney from Doximity came on Health Tip once, and he said at one point the board had to appoint a special committee to identify what the interest of the board was. Because there were so many people in Hippocrates who had money in at so many different levels, so many different preference shares that they couldn't figure out who was trying to get out, who was going to get out at what price, and it was confusing. But James, I'd love to hear more about what you think about this kind of exit.
Yeah, I mean, this stuff is it's tough, right? Because there is a nuance between different companies. I mean, I'd say that the thing for private companies that are almost semi-public are mostly ones within the Musconomy. So, like, say, XAI, SpaceX, et cetera, those trade almost like public stocks, just within private markets and stuff. But most other stuff, you still need to get out somehow, and you need to get out through IPO. And the issue that I hear plenty of complaints the VCs want the companies to IPO. The only problem is they look at it and yes, they'll get destroyed in the public markets for multiple reasons in terms of it. And it's just not going to be able to happen. Now, just to be fair to like 200x or 300x or 500x revenue, I mean, you take a pre-revenue, say, medical device or a therapeutics company and then you try to value it. I mean, any value that you put on it that's greater than zero is an infinite like is an infinite price to revenue like ratio, right? So it's I mean, it depends. Like if they really think that it's going to grow, that's kind of like rate or whatever. But you can do the calculations on it. You can like definitely cast doubt on if they're ever going to grow into their valuation. But there is a reason for it, like really, really, really high, like, price to revenue ratio, value to revenue ratios, if you think the thing is going to grow a ton. But yeah, I mean, it's tough in this environment. I just say that as far as it goes, the VCs aren't doing particularly well, especially within this particular area. It's at the end of the day, it's like they still need to get out. There still aren't that many alternatives. Secondaries are arguable at this point, but usually it's just the hype companies that are able to utilize those. And someone like Hippocratic or whatever, it's like I doubt it, unless the VC is trying to cash out at like a 80% discount to the last round or something like that, in which case that they probably wiped out most of their return and it no longer looks like VC returns anymore. Um, it's just a tough market for a lot of these private companies, and a lot of them are staying private just because, yeah, you're right. They will get destroyed in public markets, but it's not because they don't want to do it. It's because they can't get out. So there's a distinction between I'm trying to hide it from the market and I'm trapped here. And I'd say that most folks are trapped here more than anything else.
I think there's a little bit of like a Neiman Marcus sale going on in the mall, right? So you go to Neiman Marcus and you see like whatever an evening gown, right? And they're saying 80% off. Well, I mean, it was $10,000, now it's 2,000. I mean, it's still crazy, right? So I think there's a little bit of that going on as well. We're gonna jack up the valuation as much as possible, and then even if it's 80% discount, we're still gonna get out on top. So I think there's a little bit of that going on.
But
And
they,
if
but
you're
usually they don't though. That's the issue. It's just like
if
usually
you're
they
General
don't.
Catalyst, I don't know. To me, from what I'm hearing, they can often push their shares to the next guy. Um, to me, it's a little weird because I always thought a reputation should be important, but it doesn't seem to be in some of these areas. But you know,
I mean, it's part of the nature of getting big. I mean, the criticism that I think is right is they've become huge, so their incentive structures, everything has changed quite a bit. I think you wrote about this, and it's a common saying, two is greater than 20, as long as your AUM is high enough, and you
yeah,
can make money in other ways for it. Yeah, ultimately, in the longer term, they still need to return money to LPs, limited partners, like the investors in the funds. They still need to get the stuff out. And the problem with the secondaries, again, is like, and I'll just say this just from seeing the market. There's a lot of talk about secondaries. It generally doesn't happen. Like usually the secondaries firms will approach VCs and basically say, I will buy your best company out of your portfolio at, the 80%, 90% discount, and I will not take your other companies, or I'll only take them for like next to free. Like that doesn't tend to look like a great like deal in terms of it, which is why a lot of these things just don't happen, no matter what like secondaries firms say like, oh, a bunch of great deals are happening. Well, obviously that's their incentive, right? To talk about it that way. But it's just usually quite an unattractive deal, which is why a lot of these transactions also aren't happening. So that's also why VCs haven't been returning money to their LPs, which is a complaint from all the LPs. It's not that they're able to exit and then something's happened. If that actually happened, the VC market would actually unfreeze some because then LPs would get their money back and then they'd be able to put more money into VC. The problem is that cycle has been frozen. They committed a bunch. A lot of the capital isn't actually getting deployed, but also no capital is coming back from the funds. So there's no cycle, and the entire thing is just a frozen tundra in terms of a lot of the different private markets and VC right now.
But they continue investing, LPs continue pouring money, and that's to me is a big mystery, But
lots of mysteries here, but we talked about lots of important things. But I'm trying to position myself as and actually I'm a startup founder as well, and there are lots of startup founders that are going to listen to this episode. What kind of lessons should they learn from everything we discussed in their startup journey?
Well, I mean, I have some general advice. I think it's super hard. I do a lot of work harassing, VCs on behalf of early stage founders. And it's a brutal thing. I did a survey of early stage health tech companies in the height of the craziness, I think 2022, on behalf of a professional services company when I was still running the remnants of Health 2.0, Catalyst to Health 2.0. And you can see the survey. And even at that point, right, where you heard $100 million rounds coming down from falling off trees all the time, 50% of startup founders said it was really, really hard for them to raise money. And it just is. By definition, more people are calling the VCs than there are. So the number one piece of advice is really to think about, do you want to spend 2 years of your life or maybe more, trying to raise enough money to get this business going? That's number one. Number two is, can you do it another way? Is there a way that you can make it on revenue? Don't forget the most successful company in the history of America. Well, one of them, Microsoft, done all on revenue, right? Didn't have any VC backed, and there's plenty of examples of companies that did it that way, did it without or raising a dribble, right? My advice is, can you see this thing really taking off? I mean, if you're beating your head against the wall for months, years, a year, several years, you've got a thing and nobody cares. That's the market telling you something, So I always like to say, is the thing taking off dramatically? So, then that's a great thing you can then take to investor, and then you can be choosing the investor rather than, begging for the investor. And the third thing, which I think is what James's point, is that you should be very judicious in, once you're in that position where it's working, your people are offering you money, you're having good conversation with VCs, you be very judicious about how much you take and how much it's going to cost you to build out. But you don't want to run out. So, because there could be a time when it comes, and you've got to be able to say, well, yeah, things weren't going as well as I thought. We didn't get to break even as quickly as I thought, or this other opportunity came up, or something happened. And we want to have a bit of flexibility. And my great example here is go back to our friends at Doximity, who were profitable, took $50 million in, led by Canvas, Rebecca in there, super smart investor who doesn't make many investments, but they're usually very good when she does. She put it in, and they that $50 million, if you look at their S1, sat on their balance sheet for the rest of the time until they went public, and it probably turned into like 2 billion by the time they went public. It's worth a lot of money now. And I always, wonder, why did they do that? Why did they take money when they didn't really need it? And I think the answer was they wanted just to have some assurance that in case things didn't go the way they thought or whatever, they weren't going to, and they were running on fumes and weren't as profitable as they thought they were, that, they would survive, and they're prepared to pay basically by insurance for it, rather than buy money they know they're going to spend out immediately. And then have to go back and ask again. So that's my thought, is that you should try to figure out if the thing you're building is really a really good business that people want as quickly as possible. Now, by the way, Coda, the most fastest growing company in digital health ever, knew it was doing that, raised a ton of money, and then ran into disaster. I'm talking about Cerebral right here, which was online prescribing them amphetamines, basically. But they never made, even though they were growing like crazy and could have been a very profitable business if they before they got arrested or whatever, they took in a lot of money, and so they never got out of the way and ended up with the CEO getting fired and suing his investors for trying to push them into it or whatever. So you have to think carefully about it. But yeah, it's. I mean, I would say that there are some of these businesses that are never going to work if they don't get the first 1 to 5 million in. You're never going to figure out if it does work or not. So you can't avoid it.
I mean, I think I think I completely echo Matthew's points in terms of that. The thing that is always attractive to early founders, first-time founders, whatever, is just take in as much money as possible, at whatever points possible or whatever, and in a way that you would never do if you did it on a loan, right? Like if you thought about it as a loan, you would realize like I can't make use of this money in this particular way, and thus it's not a good idea because I can't pay this money back or whatever. It always feels easier if it's equity because you technically don't have to pay that back. But ultimately, that's still costing you in terms of overall like cap table, in terms of what your equity is. It also costs you down the line in terms of if there's a down round, if there's other things. Down rounds are terrible from the perspective of with a company, like you end up having everyone crushed in the cap table. And if you play around with the math, you'll actually see the down round effects are actually much, much, much worse for your overall, you know, like ultimate as a founder or even as an early stage investor, but as a founder, like what outcomes you get. This is partially how TruePill ended up with nothing, right? Like there are other reasons and other stuff, but even if they got the full amount, whatever it is, like the down round would have crushed them into almost nothing just because of the way that multiplicative effects in these things work. You want to think of it almost again like a loan. You know that I can make use of this money. In the case of Doximity, like insurance is fine. Like you know you can make use of it as insurance and you're willing to pay like the interest, quote unquote. That's totally fine. But you need to know why you're doing this. And I know it's super attractive, especially as you're struggling and bootstrapping through and like eating ramen and other stuff to try to make the company work to just like if I get a bunch of money, everything will be solved. But usually the reality is it isn't. Like the money doesn't usually solve these problems. Ultimately, what you need is the business to work, in which case maybe you don't even need the money. That'd be great. But if you do need the money and you know exactly where you'll put it, that's the right time to do it. Otherwise, you shouldn't just willy-nilly walk into it because that's just deleterious to everyone. And again, it's really easy to say this. It's really easy. The startup journeys are super hard, and I felt this myself through some of mine. But you really do need to put thought into it and know exactly how you're going to get to that next milestone where the money is worth it. So that's really the thing I'd say to encourage folks to really think hard about, because it's just too easy to like take the money and whatever if you're offered.
Yeah, when you, I think when the next time James Wong calls you and tries to get you to invest in your company, you have to call the other James Wong and say, "Is this a good idea?"
I mean, the reality is that I'm not sure like how much people, I mean, I think they should listen to this podcast for this ideas and suggestions and kind of thoughts. But in reality, you know, unless you're somebody like Munjal from Hippocratic who just have all this easy money falling from the sky, I think most founders are looking for pretty much any way to find capital. Like in my startup, you know, we ended up bootstrapping, but honestly, not by choice. It just kind of happened. Um, and so, but if there is a choice, I would say definitely look for investors who are similar minded, that are easy kind of to communicate with. They're not going to be authoritarian. If you know if you can kind of predict that sometimes you cannot, because I think the last thing you want is for investors taking over your business and kind of questioning your initial mission. Because I think in the end of the day, there are a lot of smart investors, but that's your idea as a founder. You came up with that. That's your innovation. So every time somebody says, "Oh, look at the market," you have to pivot. I think you have to ask yourself, like, what are you doing here? And Matthew gave an example of Doximity. I'm looking at my spreadsheet, and I'm going to give an example of Vivo Systems. So there's a company, Vivo Systems, publicly traded, VEEV. I have no ownership in that. I'm just looking at spreadsheet who is the most successful company in my spreadsheet that's a venture capital backed, which means it's not number one in the spreadsheet, but it's extra number 5 because that's the highest VC backed. So this is what they've done. This is basically a CRM sort of Salesforce kind of CRM company for medical organizations. And sure enough, it's the former Salesforce executive who started the company. And what they did was basically they said, you know what, we're just gonna focus. We're just gonna focus on our costs. We're just gonna make profitability as our top goal. Not some growth, not some mission, just profitability. So they found an early investor, Emergence Capital. So it wasn't one of the big guys, right? So and they only got $4 million, and after that they quickly became profitable. And now they're, I think, almost $40 billion company. So out of 4 billion, venture capital money made profit because that was their focus, and said, "Thank you very much. We're going to take it from there." And so they basically, and I think the lesson there is that basically VCs completely trusted founders' mission and vision, and they kind of stayed away. They said, "We're just going to invest in you. We trust you with the judgment." And they stayed the hell out of the company, and the company did well. So that's kind of like that's by the way the outlier. On average, we see that companies didn't do so well. So,
and Viva's a great example, right? They essentially they knew their clients. They had their clients lined up. They basically did it on revenue.
So
they got a little bit of
VC back, to be honest, right?
They gave a bit of walking around money to make sure that they were okay. But and it was a while ago, right? That was like 2012, 2013, when they went public in 2016, something like that, 2017.
2017. So to me, it actually sounds a little bit like spun-off company, which usually do well because they already have connections and corporate backing. But so I actually, maybe I should reclassify the company in my spreadsheet.
So one last quick question, and we actually did not talk about tech the whole episode, but I was kind of wanted to end with the tech. There's this trend, and lots of people saying that we're gonna see soon lots of companies with 1 or 2 employees with the help of AI that might become unicorns. Do you think with the help of AI, startup founders for them it's going to be much easier to bootstrap now? Because you don't need to raise millions of dollars because you don't need staff of 300 people. What do you think?
I've heard this story forever, right? Oh, it's so cheap now that there's web-based tools to build a thing and do this, and you can do it for no money. And all the time, companies raise more and more money. In the end, especially in healthcare, you have to go sell it to somebody, which either requires massively expensive consumer advertising or massively long sales cycles with, Biff the sales guy, who knows all the people at the hospital or the health plan or whatever. It seems to me that maybe the technology generation is cheaper. Certainly, it was cheaper. I was in a startup in 2000. We had a sun-like array server in an office with a cooling system, whatever. And then by 2005, 8, 10, no one had that because you had rack space, and now everyone has AWS. Well, they charge you a lot of money. So it's definitely cheaper. The technology is cost of building technology becoming down and down all the time. And apparently now one smart guy, Sergey, with his, using Claude can program, what would take 1,000 people back in the NASA time or whatever. So I think I hear that, but I don't see the cost of staffing out a full company to be much cheaper, but maybe I'm wrong.
I would agree with Matthew that I think AI may things on the margin more efficient. I don't see how that's gonna necessarily change company changing with like solo founder and like nobody else and like build something with all this like cursor or whatever. I think like long term, I don't think it's sustainable. I think first of all, it's going to help larger companies to fight efficiency. I think that's what I'm seeing. So like whatever, 1,000, 2,000 person companies maybe fighting some inefficiencies. I think that's to me more realistic. Having said that, I think a lot of this AI scribes that Matthew mentioned, a lot of them basically exactly what it was. They took a wrapper around ChatGPT, and here we go. We have an AI scribe company. So I count 126 in my sample. I don't see many innovators there. So here we go. So sometimes I think AI could be good, but in this case, I think it's kind of crowding the market with all these AI tourists, unfortunately.
Yeah, I'll take a slightly different perspective on this. And if you look at sort of a longer term span, and actually going back to some of the Matthew's point in terms of back in the day, VCs used to fund ideas more. But also the valuations were much lower, at least relatively speaking, inflation, whatever, what have you, back in the day. Why? Because to start a company, say Nvidia, in terms of starting out, you needed a bunch of people, you needed a bunch of hardware, you needed a bunch of different things. And even for a web startup or whatever, you needed your own servers, you needed someone to manage them, you needed a bunch of different people to do all this. And then over time, you got AWS and things, you got cloud-based stuff. It became easier to program because you weren't doing it in COBOL and whatever, I'm sort of making it exaggerating, but just over time, developer productivity tools, a lot of these other things for these software startups became easier. This is also another step in that direction. Just like you had a bunch of frameworks and stuff and like package managers and other stuff that make just building the code easier. This will probably make building the code easier, and maybe you can actually get further before you need to raise any funding and hire more people. So two people in a garage can do even more now than before, in which case I like to talk about market inefficiencies, but at least this part of the market's somewhat efficient where, yeah, probably entry valuations will get higher for VC. And that's a good thing because the companies are further along, there's more progress, there's more other things. But that's, I think, how the adjustment will work. It's not a sea change suddenly where it's just like, okay, now like two people are, running Doximity or whatever, and it's just like all done in terms of that. It's just more likely it's like, okay, entry valuation, some of these other things will be higher because it'll be easier for you to go for longer and do stuff with fewer people, which is great. But that's the same as package managers and everything else. It's an incremental step in that direction. Maybe it's a big incremental step, but it's not a fundamental change in how the market has been evolving anyway.
My hope for AI that it could, and I think it's already doing that, could generate, much better ideas, much better innovation, and eventual value add to our industry.
All right. I think we had another amazing episode. Lots of great insights. Thank you so much, gentlemen. And yeah, looking forward to hear some feedback about our thoughts.
Thanks a
Thank you,
lot.
Alex.
This is great. Awesome. Thanks, everyone.